Manishi Raychaudhuri, CEO of Emma Capital Partners, to join us on the show this morning. Thank you so much, Manishi, for waiting by very patiently. That was quite the wait there, but one thing I wanted to start with is there a case for investors also to be patient right now? Given the kind of sell-off that you've seen, is there a read that you have right now in terms of investors to not panic? Because how are you reading into the sharp sell-off that we've seen, especially on Friday?
Well, thank you very much for having me here. It's difficult to assign a reason to the degree of volatility on a particular day, because there's no fundamental reason typically. I mean, there were quite a few things happening on Friday. For example, the MSCI rebalancing, which, was supposed to sort of lead to some passive selling in India. But I must also point out that typically these changes or the so-called rebal executions, they actually typically the investors don't really wait for the last day, so they would have been executing these trades for quite some time. But apart from that, I think India's problem at this point of time is clearly in fundamentals. It's not any of these short-term technical reasons. If you look at the whole of Asia, Asia has seen very significant earnings estimate upgrades, predominantly led by Korea and Taiwan. So over the last 6 months, Korean consensus EPS estimate for 2026 has moved up 76%. For Taiwan, it's about 19 to 20%. There are other countries, other markets, which are also beneficiaries of these earnings estimate upgrades. We have seen so in Malaysia, in Thailand, in Hong Kong, China to a slightly lesser extent. India, and by the way, Philippines, a very small market, is conspicuous in this whole array by the fact that their earnings estimates have declined. And for India, it has declined about 4 to 5% over the last 6 months. So as of now, all this massive, the fiscal stimulus that we saw in 2025 through direct tax cuts and indirect tax cuts, they're not really feeding through in terms of significantly higher consumption sentiment. So I think that is what investors, particularly foreign investors, are really looking at. They have the entire emerging market firmament to play with. They have these huge gainers in terms of the AI capex infrastructure players like SK Hynix or Samsung or TSMC or some of the Chinese, semiconductor manufacturers. They have some of the robotics and AI plays in China. In contrast, they don't really have those equivalents in India. On the other hand, some of the sectors in India, like the IT services, they have now been talked about as AI losers. So all this is kind of acting against India for now. We may have to wait for the AI frenzy to fade away before India is again focused on.
Right, absolutely. And we'll come to that AI and that entire IT picture as well in just a bit. But what I also wanted to get a sense of in terms of what you think about this is when you talk about levels, and you've already given a little bit of a prelude to this answer in what you've just said, but just months ago, you did have 26,000. That was a hill that Nifty seemed to be falling from every now and then. As of Friday, 25,200 was breached, and bouts of weakness is largely what you're seeing coming in every now and then. Is that something that concerns you right
now? I think, as I again said, that this short-term volatility is something that we have to live with. But what concerns me a lot more are actually the medium to long-term fundamentals. We have to get the basics right. We have to get the earnings estimates moving upwards so that the confidence in the longer-term earnings growth of around early to mid-teens, that comes back. Until and unless the confidence in the forecast earnings growth comes back, we will not see sustainable, robust flows into India.
And that's something that we're also looking at. But as we head into March, I'm also curious to hear what you think about IT as well. Now, you've talked about the AI frenzy as well, but given that it posted the worst month in Feb, concerns galore really for the sector. So how are you looking at IT particularly?
Well, in one short answer, I have an Asia ex-Japan model portfolio that we recommend to clients, I don't have a single Indian IT stock in that portfolio, and I haven't had any of them since middle of last year. So Indian IT as of now is, of course, a classic IT loser. We know that clients in the Western Hemisphere are actually talking to the Indian IT companies in terms of renegotiating pricing, taking into account the presence of AI agents in their team. So the kind of margins, the kind of man-hour rates that the IT companies were earlier able to charge, it is clear that they won't be able to charge those man-hour rates or those margins going forward. And that obviously means that the valuations that these companies are trading at are also not appropriate. I mean, if you look at the top rung Indian IT companies, their forecast earnings growth going forward is in single digits, about 6-7%. They're trading at somewhere close to 20 times. 1 year forward P is possibly in the range of 18 to 20 times, which is clearly not justifiable by the kind of earnings growth forecasts that they have.
Right, absolutely. And I also wanted to quickly get a sense of oil and gas in terms of whether or not you're still constructive when it comes to this particular sector.
Now, this is, honestly, it's coming as a surprise to me. First of all, the stability in oil prices. I mean, Brent is still in the range of about 70 to 71. If we were about 3 to 5 years back, if we go back there, oil prices would have been far more volatile in the kind of geopolitical, news flow or geopolitical tensions that we are seeing today. But it also means that the oil marketing companies' margins would possibly stay stable and could even move up slightly. And that is the reason why the oil sector, the refiners and the oil marketing companies, their earnings estimates have actually increased, and they are, in a sense, one of the rare exceptions in the, among the Indian sectors. The other exception is, of course, basic materials, iron and steel or aluminum or copper. Their earnings estimates have moved up, like all across Asia. But those two sectors are possibly the exceptions in India right now.
And that's about those two sectors. But I quickly wanted to get a sense of which sector are you most bullish on right now in this particular market setup? Is it private banks? Now, you've already given us a little bit of a prelude in your previous conversations in terms of the fact that you're constructive when it comes to some of those private bank names as well. But which is this one sector that's standing out to you on your radar?
Right. Difficult to name one, but I can name three.
Sure.
Private banks, consumer discretionaries, industrials. In private banks, I do like most of the top rung frontline private banks, particularly those which are focused on retail lending, because I think that concern about retail lending turning bad, turning NPLs, is perhaps behind us. There's a lot of cash fiscal stimulus that is being thrown at householders, and therefore I think that concern about bad loans has possibly subsided. Industrials and consumer discretionaries, I think investors would have to be a bit selective on the valuations here, growth adjusted valuations going forward. The macro story behind these sectors look good. There's still a lot of investments, predominantly from the government, going into infrastructure, and at some point of time, that would result in private capex coming back. Consumer discretionaries should also benefit for the same reasons, the kind of fiscal stimulus that was thrown last year. But here again, one would have to be cautious about the relative valuations.
So thank you so much for taking time out and joining us this morning.